Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started. Today, we are doing a really crucial deep dive. We're looking at the financial foundations of the whole AI revolution. Everyone talks about the software, right? The cool new services.
Sure.
But we're going underneath all that. We're focusing on the massive physical stuff that makes it all run, the data centers, the chips, the networks.
And that's really our mission today. Look, the sources we've analyzed all agree AI is a transformative technology. That's not really the debate anymore.
Right.
Our focus is on the financial vulnerabilities that get created when the market assumes way too much certainty about the profits. And even more important, the timeline for those profits. We're investigating the structural risks that are being built right into the financial plumbing of this AI boom.
And the big signal we're tracking, the thing that stands out, is this foundational shift in how big tech even operates. For 20 years, these companies were kind of lean giants. But now this AI arms race is forcing them to become, I don't know, construction companies, power utilities, and hardware makers all at once. The amount of money here is just staggering.
It is. It's a historical pivot. If you think back, the big tech model was famously asset light.
Right, they focused on software.
Exactly. They maximize cash flow, they outsource the physical stuff. Now they are moving headfirst into a really capital-intensive model. They're aggressively building out tangible infrastructure, huge data centers, their own networks, and all those specialized accelerator chips.
And the key thing that makes this so significant financially is how they're paying for all of it. It's not just pocket change from their cash flow.
No.
According to some recent reporting from Reuters, big tech has gone out and raised nearly $100 billion through bond issues just to fund this expansion.
$100 billion. And that's debt. That's money they have to pay back, all
Yeah.
secured by the promise of future AI returns.
So that completely changes their risk profile, doesn't it?
It changes everything. And the Wall Street Journal's analysis really reinforces this. They are all pouring into the debt market for this AI build-out. What investors really need to get is that these aren't just, generic corporate bonds. The risk here is structural. So in a potential AI bubble scenario, even those supposedly safe corporate bonds might not protect you. They're tied directly to the value of the infrastructure being built.
Hold on, isn't this just normal business risk, though? I mean, a company builds a new factory, they take out a loan. If the new product doesn't sell, the company gets hurt. Why is this AI fixed cost trap inherently worse?
It's worse because of the scale, the speed, and just the ironclad nature of the commitments. Look, when you go from renting cloud space, that's a variable cost, you can scale it up or down,
Right.
to owning $10 billion data centers funded by long-term bonds, you lock in these massive fixed costs. That debt has to be paid, the buildings have to be maintained, whether you're using 10% of its capacity or 90%. That's the trap.
So the biggest danger isn't that AI just completely fails, but it's the consequences of what the sources are calling overconfidence in how fast the money starts rolling in. It's a timing risk.
Precisely. And we've seen this movie before. There's a clear historical echo. Just think back to the late 1990s with the telecom companies.
Oh, yeah.
They invested these enormous sums building out fiber optic networks everywhere. Now, the sources remind us that infrastructure was ultimately revolutionary. It gave us the internet we have today.
But the companies that built it got crushed. I remember they called it dark fiber because so much of it was just sitting in the ground unused for years.
Exactly. A technological success, but a financial disaster for many of the builders. All because of overcapacity and revenue that came way later than expected. That's the exact feeling we need to watch out for today. If AI adoption is delayed by even a year or two, that locked-in fixed cost structure becomes incredibly dangerous.
I get the pain points, but can you break down the actual mechanism? Like what happens when that cash flow slows down, even just a little?
Okay, so you get this triple pressure point hitting the balance sheet all at once. First, you've got higher interest expenses on that $100 billion plus in debt. You have to pay that no matter what.
Of course.
Second, your capital costs go up because the market gets nervous and it costs more to borrow in the future. And third, and this is the sneaky one, you have a massive problem with depreciation costs on all that new physical hardware.
Okay, let's pause on depreciation for a second. For anyone not deep in accounting, that's just the required write-down of an asset's value over time, right? It's a non-cash expense. Why is that suddenly a huge problem?
It's a huge problem because it hammers your profits. When your revenues slow down, that mandatory scheduled depreciation of $1 billion data center starts to eat up a much bigger slice of whatever profit is left.
Yeah.
It squeezes your margins before you even account for the interest payments.
So it's like a paper loss that becomes a very real problem.
A very real problem. And if the asset underperforms long enough, the company might be forced to take what's called an impairment charge, which just wipes out billions in value on paper and sends a huge shockwave through the market.
And this is where it gets really interesting, because the sources are warning this adjustment won't look like a classic tech crash where just the high-flying stocks fall. They call it the erasure of the confidence premium.
This is the absolute core insight. The confidence premium is just the market pricing in all those amazing far-off AI profits today.
Right, assuming everything goes perfectly.
Perfectly and immediately. And that premium is baked into both the high stock prices and the super low borrowing costs big tech is enjoying right now.
So if that confidence suddenly evaporates, what does that mean for stocks and bonds at the same time?
It means you get a dual hit, a 1-2 punch. Stockholders panic because that huge valuation premium just vanishes when the certainty of future money is questioned. At the exact same time, bondholders, pension funds, big institutions start to really worry about the company's ability to pay back all that debt.
So the very bonds that fueled the boom.
They become the source of the instability. The credit market pressure makes the stock pressure worse, and the stock pressure makes the credit market pressure worse. It's a vicious cycle.
That shared vulnerability across both asset classes, that's the real structural risk here.
It is. Investors have priced in perfection, and even a slight delay erases that confidence premium from everything.
Okay, let's shift to the assets themselves,
Yeah.
because there's another layer of risk here, right? Technological obsolescence. A data center building might last 30 years, but the valuable stuff inside, not so much.
Not at all. And S&P Global Ratings really highlights this from a credit risk angle. They note that the accelerator chips and servers, the brains of the operation, face serious replacement pressure every 3 to 5 years.
3 to 5 years, wow.
Yeah, in this AI arms race, the second you install the best hardware, the clock is already ticking. You're constantly having to spend billions more just to stay in the game.
This means companies are fighting two almost contradictory risks, and both lead back to that fixed cost trap. Can you walk us through the first one, the Simpson slower adoption scenario?
Sure, that's the more intuitive one. Companies build all this stuff based on super optimistic forecasts for how much it'll be used. But what if businesses adopt AI more slowly, or they build their own smaller models? The giant data center is sitting there, but utilization is low. If they can only charge half of what they planned, the whole financial model that supports the debt just breaks.
Okay, that makes sense. But the second risk is the real paradox, the one that's harder to wrap your head around. Too fast efficiency.
This is the big irony in all of this. Reports coming out of places like Stanford suggest that the AI software itself, the models, they're getting better and more efficient at an incredible rate.
Okay.
So imagine a factory buys 10 brand new, super expensive, specialized machines. 6 months later, a brilliant software update comes out that lets 5 of those machines do the exact same work as the original 10.
Oh, you suddenly have 5 machines you don't need. You have 50% overcapacity.
Precisely. The very success of AI innovation starts to eat away at the need for more and more hardware. You achieve the same results with less power, fewer servers than you projected when you took on all that debt.
So your massive capital investment, which is now a fixed cost depreciation plus interest, it's destroying your profit margins not because demand failed, but because your own technology succeeded too quickly.
Exactly. In both scenarios, slower adoption or faster efficiency, the outcome is the same. Billions of dollars of fixed assets that aren't being used effectively.
The sources warn that today's high-tech server farms could basically become the empty factories of past investment bubbles.
That's the metaphor. The money is spent, the debt is locked in, and the asset is either underused or it's already obsolete.
Now, this sounds like a problem for big tech's balance sheets, but the sources say this risk is actually spilling out into the wider financial system.
Yeah, what's fascinating is that this AI infrastructure boom isn't just about the biggest tech firms anymore. Bloomberg reports that the development of these huge data center campuses is shifting to specialized developers and a whole pool of different players. Many of them have a lot less experience managing these kinds of projects.
And I'm guessing they have a different way of getting money than the tech giants.
You guessed it. They're relying heavily on things like structured project finance and the booming private credit market. So you have this AI debt boom combined with what Bloomberg calls an environment of easy capital.
And that's the classic recipe for overinvestment.
It is the textbook definition. Easy money allows for overly optimistic assumptions to run wild.
So this brings up a huge question for the whole economy, not just for these companies. What is this massive construction boom doing to inflation?
That is a key macro risk for the coming years, and Reuters' analysis suggests investors might be really underestimating it. Building these things is incredibly resource intensive. You need tons of power, specialized equipment, skilled labor, specific supply chains. If that demand outstrips supply, you see inflation start to creep up everywhere.
And that connects directly back to those high-growth stocks through interest rates. If AI demand pushes inflation up, that could influence what the Federal Reserve does.
Absolutely. If the Fed has to keep interest rates higher for longer to fight this infrastructure-driven inflation, it puts pressure on two things at once. First, it makes it more expensive to pay back that $100 billion in debt.
Okay.
And second, it raises the discount rates analysts use to value all those future AI profits.
And just to be clear for everyone listening, the higher that discount rate goes, the less those future profits are worth in today's money.
Exactly. So you get this bizarre scenario where the amazing AI growth story pushes stocks up, but the messy reality of financing that growth pulls them right back down. It's a double negative feedback loop.
So if you're an investor trying to make sense of this, you can believe that AI is a huge long-term trend, but you still have to protect yourself from this overconfidence premium we've been talking about. How do you even do that?
That's the main takeaway. Stop debating if AI is real. Of course it is. Instead, focus on modeling the risk of overconfidence and what it does to these highly leveraged companies.
So the sources suggest three practical questions every investor should be asking to check for this vulnerability. What's the first one?
The first one is about the basic financial structure. You have to ask, is this business model super sensitive to debt, to long-term contracts, and to utilization rates? If the answer is yes, that company is walking right into the fixed cost trap.
Okay, and the second question gets at that obsolescence paradox.
Right. Is the payback period for all this capital spending way too long compared to how fast the technology becomes obsolete? If your chips have to be replaced every 3 years, you probably shouldn't be funding them with 10-year debt. That timing mismatch can be lethal.
And the third question ties it all back to the macro picture.
You have to ask, is the entire valuation of this company set up to get hit twice pressure on its stock and its bonds if interest rates go up or just stay higher for longer? If a company is banking on cheap debt and far-off exponential growth, it's incredibly vulnerable to that dual pressure scenario.
So tying this all together, what's the big final thought our listeners should be mulling over?
Look, the growth of AI is undeniable. The real challenge for you is structuring your investments to absorb the shock when that confidence premium collapses. The lesson from history is that the risk is rarely the technology itself failing. It's the over-leveraged, aggressive financing of the rollout that goes wrong. And we need to remember, this isn't just about big tech. This debt-fueled investment is distorting capital allocation across the whole economy. It could be starving other, smaller, potentially crucial innovations of funding. We might be creating an AI-centric monoculture, and that's a systemic risk that needs very careful thought.
Don't forget to subscribe and hit that like button.